Hi folks, Scott here, and this is the wrap for Monday, June 17th. So, let me adjust the mic here a little bit. We had an unfilled up gap today. This is a chart of the S&P 500 futures to be specific, but if you look at your spider chart, if that's what you trade or monitor, you'll see it's virtually identical on the intraday action because of the extremely high correlation, because they're tracking with the same core index. Now, the reason you know it's an unfilled gap is the low of today. This is today's 5-minute chart, sort of scrunched up. The low there is above the blue line, which is yesterday or Friday's closing price. So an unfilled up gap, that's in play. That'll show up in our worksheet for our members in the morning. And I've showed it many, many times in these daily videos. Another consideration going into tomorrow is the day before Fed Day. That'll also be covered by the daily worksheet that I share with our members. And I've shown that quite a bit as well. Something I don't think I've shown recently is fading gaps on Tuesdays of Options Expiration Week. That is not covered in our worksheet, so I'm going to show that for the benefit of our members and non-members who may be watching this video. So this is showing you the results of fading gaps on Tuesday of Options Expiration Week, and specifically when above the 200-day moving average, but not considering the 10 or 20-day moving averages, because we're just barely below the 20, the white one. We're just barely above the yellow one, which is the 10-day moving average. So that's really noise, if you will. So let me use CapTrader, my back testing tool. And there you go. Odds are 50-50 in terms of which way we're likely to gap, and using an end-of-the-day stop, it's favored the long side clearly, right? Down gaps have had a much higher win rate than shorting up gaps, and we've tended to have more sizable moves to the upside on the ones that did not fill when shorting up gaps. Something I haven't done. So before I run this with our, in fact, let me show you one thing that I have to show you before I forget. I normally don't show this in this video because it's one of the benefits for our members, but the delta is so big, the variance is so big, I think it's important that I share it, because I just, in good faith, would feel bad not to share it. Look how these numbers change. I think this was a similar scenario with a flip-flop that I showed in the weekend video, and these are completely different patterns, so it's a little bit unusual. So I reran this with MTG stop parameters, which is 30% of the 5-day ATR, volatility adjusted stop. Check that out. It goes from having a long bias to favoring shorting if you're using an intraday stop. What that means is that you're likely to take heat, adverse excursion on a gap down. But if you delay your entry or wait long enough, you got a chance of capturing a really nice win to the upside, because it's not likely to sell off a bunch, or less likely to sell off a bunch to the downside. And vice versa, all of those gaps up that filled using an end-of-the-day stop, every single one of them, all 22, could have been captured using a reasonable intraday stop equal to 30% of the 5-day ATR. So that's interesting. Again, pretty unusual, especially 2 videos in a row. I don't know if I've ever seen this, where they flip-flop on completely different patterns. Now, one thing I want to do out of my own curiosity is see what happens when we add a 50-day moving average. I have not tested this yet. See if that makes any difference whatsoever. Now, you should be thinking, well, Scott, let's go reduce the sample size. And you would be correct. Right, we'll take these 72 trades and only look at the ones that have closed above the 50-day moving average. Probably drop it by 40% or so would be my guess. Maybe 50%. Oh, maybe less. So the majority of the times when you're above the 200, this is showing you, at least on Tuesday of Options Expiration Week, we've also been above the 50. But no real change in what I just showed you. It does clearly have a short bias, a slight short bias. For tomorrow, Tuesday of Options Expiration Week. So keep that in mind going into tomorrow. All right. Just a quick promo reminder. If you're not a member, you might be interested in learning more about membership on the 25th. I'll take you through the basics of how I and other members use our MTG guides and just sort of explain what's in each of these daily videos that you may be watching. All right. I want to show you. Let's show the worksheet first. The indices opened in different areas today, but really, regardless of where they opened, there was nothing real attractive. Opening above the highs, which I think some indices did, that was not attractive. 40% win rate going for gap fill and a profit factor of 0.9. Anything less than 1 means it's lost money historically. Between the high and the close, that was just dead neutral to weak. And there are really two zones here, our DOC zone and the DOH zone, and most indices are in the DOH zone, which is just problematic historically. So for time's sake, there's really nothing to show you. Just the numbers weren't very good, and they were consistent. So, in fact, I will show you this just so you don't have to take my word for it. Let me show you what I mean. So we'll look at the DHO zone, which most indices open in this zone today. 49% historical win rate using a volatility adjusted stop equal to 6.25 points today for the ES. No thank you. Dead break even historically. YM 45% win rate and a 0.7 prop factor. Yuck. NASDAQ neutral 60 and a 1.08, and the Russell 52 and 0.74. ETFs much of the same because again these things all highly correlated. Now sometimes they'll be off a little bit, they'll vary a little bit, but that's not the norm. Nothing interesting there, nothing interesting there, the DHO zone, nothing there, and nothing there. So easy pass for me, and that's essentially what I said here. There was really no other research that just dissuaded me from that core assumption or core observation from the guides. The weekend's video wrap, up gaps on Mondays after closing below the 20 and above the 200. Just dead break even. Nothing really attractive there. And if large, problematic here. Large is greater than 40% of the 5-day ATR, which means opening above 1627, which we did by about 4 points, 5 of 16 historically, so now including today, 5 of 17. Again, that's using our MTG stops. See, large. What was interesting, large up gaps, June and July in the summer tend to be a little bit weaker months. And you can see it here, large up gaps in June above the 200. They've actually had a good success rate for filling. So I wanted to point that out. But overall, neutral to weak probabilities per the guides. Mixed data in terms of unique factors. Cross currents persist. No clear edge, so no fade for me. That was a good decision because I would have been stopped out had I traded it. You see the market's open right here at 1331.50, I believe, and rallied straight up, would have stopped you out. Rallied all the way to 41 even, so 10 points. Avoided losing gap fade, which is fantastic, but then it rolled over. The 15-minute range guys clearly favored the high breakout. I had some concerns. Let me show you those real quickly. So going long, one tick above the 15-minute high, 1536.75 with a 6.25 stop and a 4.25 target. I decided to use a 4.25 target, unfortunately. And what I mean by that is, first let me show you the odds were really good. Clearly delineated. 60% win rate, 1.3. I'm looking for 55 and 1.1 here. Check. Check on the Dow. Check on the NASDAQ, 3 for 3. Russell, neutral, but not bad. Just neutral, looking at the ETFs. Spider confirmed, Diamonds confirmed, and Q's right at it, just a tad weak, but the Russell confirmed. So for all intents and purposes, you had 7 of the 8 favoring it. There were some concerns in the advanced study, showed the macro market conditions were not set up well for the S&P. The Russell was acting a little bit weird, so I only traded half size and only traded the ES today. So people question me about that. The reason I only traded the normally I'll split like quarter and a quarter here to equal a half size. Today I stuck with the ES, and as I explained in the trading room, the ES was showing me more bullish relative strength compared to the recent highs. It broke clearly through Friday's highs and was consolidating, whereas the Russell was really struggling and right at those highs. That was one concern. Secondly, in a relative sense, it was just acting weaker than these other 3 markets. And then there was a third reason I can't remember right now. The TF. If you go back and look at the video that I was just showing you, rewind, you'll see that the TF did not actually meet my criteria. So always prefer the instrument I'm trading meet my criteria. So put all my eggs in the one basket, but only traded half size, and it went to exactly 4.25 points. I went long at 1636.75. Add 4.25 to that, and it equals 1641. And it went to 1641. That's the good news. Bad news is it didn't fill me. Tightened my stop to 2 ticks below my entry, and I lost 2 ticks. Unbelievable. I watched it a little bit, explained to folks over the long term. Just cost you more money taking profits early. Maybe in retrospect, looking at the confluence of resistance up here, I was pushing it, and knowing the macro market conditions were not as favorable as shown per our advanced studies. But bottom line is, I thought I was going to make $200 per contract, and instead, lost 25 bucks a contract. That's a little disappointing, but no big deal. Essentially a scratch trade. Did a couple other trades discretionary later in the day. The market just didn't follow through. Got first targets hit, not the second, and called it a day because we were trading right around the open. No real gap gotcha opportunity for me, even though it was an unfilled up gap. Just not real interesting when you're that close to the open. So anyhow, a lot of information contained in this video. Hope you listen closely. Good stuff there, and we'll see you tomorrow. Have a good one.